If you have kids and you have more than $1 million net worth, this is your structure. If you don't have kids, but you have over a $2 million net worth, this is your structure. And again, could you get away without it? Yes. Are you going to need it probably anyway? Probably anyway. You do not want your state government to decide what happens to your assets when you die. This is the worst thing that can ever happen. Hey, welcome back, everyone, to the podcast. I got a super special episode for you guys today. So inside of my Tax Strategy 365 community, one of the things that I get on there and do is just straight up teach. So in addition to getting one-on-one calls with the tax advisor, basically your questions answered within 24 hours, we also do group live coaching calls once a week, different times each week. But this one that I'm going to share with you guys is on LLCs and asset protection, and like, how do you know when you're first getting started whether or not you need an LLC or not? What are the steps of setting up an LLC? And I spent about 20 to 25 minutes teaching my Tax Strategy 365 members this a couple weeks ago, and I wanted you to have access to the same information. And you can check that out at the podcast. And if you're interested in becoming Tax Strategy 365 community member, just go to taxstrategy365.com/apply to become a client. And we'd love to see you guys in there. And for now, enjoy the podcast. One of the things that people get wrong is they're either like on one side of the spectrum. Okay. And it's so weird to explain this, but it's like they either let legal and like asset protection keep them up at night. And it's like that analysis paralysis of like, I have to get everything done the right way from the start. You know, I have to pay a bunch of lawyers. I have to ask a bunch of people questions. I have to do all these things to make sure it's done right. And then there's the people that do absolutely nothing, like that they don't take the time to ask lawyers, ask accountants, ask other people for advice. And so it's like, I've never met anybody that's just right in the perfect balance of the middle. It seems like somebody's one or the other. And I'm not saying one or the other's good or a bad thing. It's just a lot of times when people, they hear about, oh yeah, go set up an LLC. Oh, you need to own property in an LLC. Well, not all the time. And we're going to talk a little bit about today about kind of like how those steps work and just what you have to do. Because remember this, it's like, it's always quickest, easiest, cheapest to buy a property in your personal name. You're going to get the best terms, the best rates, typically no prepayment penalties or anything like that. You're going to be able to qualify based off your W-2 or your business income. If you're self-employed, I'm sorry. You know, we all know how that could be. But it's typically the quickest, cheapest, easiest to buy a property in your personal name. Well, what are the problems with that? Well, they say you could have 10 conventional loans in your personal name before you can't get conventional financing anymore. That's what typically people say. Now, on LTRs or multifamily, that doesn't turn out to be too big of a problem. For short-term rentals, I mean, show of hands, anybody here, like how many people have maxed out their debt to income after their first or second property? Like that was me when I bought one property, my first property. I was making 55K as a W-2, and I maxed out my debt to income. No bank would give me any more money. I had to wait till I either made more money or that property that I bought started making money also. So it's kind of like this hamster wheel, right? But it's always quickest, easiest, cheapest to buy a property in your personal name than it is to buy it in an LLC. When you buy it in an LLC, you got there's going to be more like title due diligence. You're probably looking at higher interest rate. You're looking at prepayment penalties potentially, and there's just a lot more things involved. So if it's like your first or second property, you know, don't fret the LLC. You know, get it in your personal name, like get the deal closed, and then we could look to transfer it into an LLC in the future. Okay. Now, in terms of like what are the steps to setting up an LLC, everybody asks this question. So I have a little quick, I'll give you guys access to this afterwards. Just a little quick and dirty 5 steps to setting up an LLC. So the first step to setting up an LLC is you want to set up your LLC at the Secretary of State website. Now, very important, very, very, very important. Remember the golden phrase. I'm dubbing this right now. You always want to set up the LLC that owns the property in the state the property is. Okay. I live in Illinois. I own a property in Florida. My Illinois LLC does not own the Florida property. I own a Florida LLC that owns the Florida property. You got it? So wherever the property is located at, that's the state where you're going to have an LLC that owns the property. Now you can have a holding company LLC, which we're going to get into. Like I have property in Colorado where, you know, I have a Wyoming holding company that owns the Colorado LLC that owns the Colorado property. You get me? Or like my Wyoming holding company owns my Florida LLC that owns my Florida property. You understand? But wherever you're investing at, whatever state, you want to have that states LLC own the property. Did we talk to somebody yesterday, Mason, or was it earlier today or yesterday, who lived in Florida, invested in Pennsylvania, but they had a Florida LLC own it? Was that what you on the call?
I don't think I was on that one, no.
Okay. But those are the types of things. And you might ask why. Well, look, I'm not a lawyer. I'm definitely not your lawyer. I'm not pretending to be a lawyer. But I've done this for people over 500 times now. If you have a Florida LLC and you go to Pennsylvania court, the judge is going to be like, "Well, you don't have any business standing here. Like, where's your Pennsylvania business certificate? Where's your this? Where's your that?" Like, the odds of you winning that court battle are slim to none. So that's why you got to have the LLC wherever you're investing at, you have an LLC of that state own the property. Okay. After that, you got to get an operating agreement. Now, if you have a single member LLC, like if it's just you, in theory, you don't need an operating agreement. I've just found it like it seems like every new bank account I set up or every single new property I set up, they want to see an operating agreement, even if it's a sole member LLC. So you might as well just get one done anyway, so that doesn't come up in the future. Especially if you have a partnership. If you guys own real estate with somebody else, I don't care if it's your mother, brother, sister-in-law, stepson, I don't care who it is. You got to get an operating agreement. If you own property with somebody that's not your spouse, get an operating agreement. The operating agreement is going to outline all the terms and conditions, basically, like when you guys subscribe to stuff on your phone or Amazon or all that, terms and conditions. What happens if, I'll tell you a real life scenario. I own a campground. I own 30% of a campground in Colorado. It does like $3 million a year in revenue. It's a big campground. One of our partners, so I own it three ways, 30, 30, 30. One of our partners is getting divorced. Well, what happens? Because her spouse is entitled to half of her share of the campground, right? Well, in order to get that person their $300,000 or $400,000 of equity, how are we going to do that? We got to sell or refi or do something with the campground. So these are all the things that you want to be thinking about if you own property with somebody else. In that operating agreement, it's going to spell out everything. If this happens, this happens. If somebody dies, this happens. If a partner gets sick and calls off work too many times, this happens. Like you just have that distilled in your operating agreement, especially if you're buying property without people that are spouses. We reviewed an operating agreement, me and Austin, if you guys have been working with Austin, where it said something along the lines of like, it was a 50-50 partnership, Joe and Jim, let's call them. And it said something like, if Joe dies, Jim gets his whole interest. And if Jim dies, Joe gets Jim's interest or something like that. Basically, each partner got the other person's interest if somebody died. And I call up Joe, the client Joe. I'm like, hey man, did you want your interest to go to the other partner if you pass away? He goes, no, I want it to go to my son. He's in real estate too. But that's not what the operating agreement said. Because you set your operating agreement up on LegalZoom and you spent $20 to have LegalZoom set it up instead of going to a lawyer. And these are the types of things like if you're buying property with other people, got to make sure it's in order because if something were to, people die at a younger age nowadays. So just be frank, like shit, stuff happens. So make sure that your operating agreements are in shape. Then you're going to get an EIN with the IRS. This is super, I think it's easier, but this could take 15 minutes. You go on the IRS website, give them your LLC information, you set up an EIN. Once you have 1, 2, and 3, that's when you go to the bank. You're going to need all those paperwork. You go to the bank with that paperwork, open up a business bank account. And then step number 5 is you want to keep good financial records of that business. So let me give you an example of this. You might have 3 properties that you own. You might have a property that you manage for somebody else, and then you might go and do a partnership with somebody else. Okay. Well, those are 3 separate businesses, right? You have your rentals, somebody else's rental, and then a rental that you own with somebody else. Keep them separate. Don't commingle everything together. There's going to be some expenses that are shared across the board, like a PMS system or, Price Labs, or, even the fees that you guys pay us, but try to keep all that separate. So it's not like we're unwinding it come tax time, right? I'm going to show you guys what a well done asset protection structure looks like. Okay. Now stick with me because each one of you is going to be running your own race with this. Where there's going to be some people here that need the whole, kitchen sink, and then there's going to be some people that just need one or the other. Okay. This is for you if you have kids and you have more than $1 million net worth, this is your structure. If you don't have kids, but you have over a $2 million net worth, this is your structure. And again, could you get away without it? Yes. Are you going to need it probably anyway as your properties and your assets and everything goes up in value? Probably anyway. So maybe take the time to set it up right the first time so that way you don't have to go and backtrack everything. So it's also worth noting that for now, at least for purposes of this call, and maybe we can get to this at a different time, but this is a structure for just your real estate. Okay. So throw everything else out, your active businesses, all the other companies that people own, CPA firms, law firms, whatever. This is just for your rentals. Okay. A good structure looks just like this. You got the client at the top. That's going to be you. They're going to own a revocable trust, revocable living trust. Why this? Well, the revocable living trust is going to outline all your wishes and where you want all your stuff to go in the event that in the event that you pass away. You do not want the government, your state government especially, to decide what happens to your assets when you die. This is the worst thing that can ever happen. And I'll give you a story. So my grandpa passed away in 2020. He was my step grandpa, but you get the point. So he had my mom, who is not his biological father, but she took care of him all the time. And in his will, he wanted my mom and my mom's brother to basically get all his stuff. Now, he didn't really have a pot to piss in, to be honest with you, but it was still a couple $100,000. It was still like just his house, which is worth like $200K, right? But in the will, when he signed his will, it had to be notarized and it had to be witnessed by two other people. And the notary didn't know that the will had to be witnessed by two people. So my grandpa's will is basically null and void. Doesn't count. Now all of his assets go to the state, and the state gets to decide what happened. So you don't want that to ever happen to you. If you have assets, good chunk of assets, you set up a trust. So a revocable living trust, depending on the state, I think you can get these set up for $2,500, $3,000 potentially, and then there's like an ongoing maintenance fee every single year. But in your trust, you're going to be able to say, okay, I want this house to go to this kid. I want this to go to that kid. I want basically everything inside your life's wishes get carried on in your trust. Okay. And, I'm not like a trust expert, so don't ask me too technical questions, but this is normally what you want to have at the top of your entity structure. Again, if your net worth's over, what do we say? If you have kids over $1 million, if you don't have kids and your net worth is over 2 million, you're going to want a structure that looks just like this. Okay. So that revocable living trust owns your holding company. Now, this can be 3 states, from my understanding: Wyoming, Ohio, or Nevada. They all have very similar entity protection, low filing fees. They keep your name out of public records, but it's typically in Wyoming. Wyoming is probably the most common state because I think they're only like $100 a year. It's super cheap. So your revocable living trust owns your Wyoming holding company. You don't own the Wyoming holding company. Your trust does. Okay. So it's not you owning the property. It's you owning the revocable living trust that owns the holding company that owns the underlying LLC that owns the property. You get me? Okay. So holding company in Wyoming, that's a single member LLC. And then it depends on where you invest at. Okay. So I have property in Illinois, Ohio, Missouri, Tennessee, Colorado, Texas, Arkansas, Florida, 8 states. So I have my holding company, and that's going to own that share of the LLC in all those states that I'm operating in. Some states I own property by myself. Cool. I got a single member LLC that's owned by my Wyoming holding company that owns the property. Some states I got a partnership. My holding company owns my share of the partnership interest, right? And so what's really cool about this sort of structure is you could have properties in 50 states. You're still filing one single tax return at the end of the year, and that's going to be your personal tax return. Because as long as everything is 100% owned, it all flows up to you individually. Whether or not you have 2 properties down here, or 5 or 20, you're still filing one single tax return. And I think that's the biggest mistake a lot of people make is married couple goes in to buy real estate. What's the first thing they do? Put both of their names on an LLC. Well, what does that happen? What does that do? You have to file an extra tax return. That's a TurboTax charges $1,700. We charge $2,000 for partnership returns. I think that's an okay fee if TurboTax only charges $1,700. But still, you don't want to do that. So you want to make sure that your structure is protecting you while also at the same time you're not paying a boatload in fees to file your tax returns every single year. Okay. Let's talk a little bit about, let's say you don't have this yet and you're trying to clean it up. One of the common questions we get is, can the lender or the bank call the loan? That's what's called the due on sale clause. Now, they say that the banks can, but will they? They tend to not, as long as you still own the interest, like whoever's the guarantor originally, which is you, your personal name, and then you transfer it to an LLC, as long as you're the sole guarantor of that LLC also, they seem to not care as long as they're getting paid. Where you're going to run into issues is, like, let's say I buy a property in my personal name and then I deed it to an LLC that me and Susie own together or me and Mason own together. That's where the bank's going to have a problem with that because Mason was not a guarantor on that loan. I was the only person, right? So that's the only time you have to worry about sort of the due on sale clause there. And then the other thing that you want to worry about when you go from transferring properties in your personal name to the LLC is transfer taxes. So some states, looking at you, Pennsylvania, Florida, California, Tennessee, Texas. I don't have all of them memorized, but some states charge a fee when you transfer it from your personal name to an LLC. Even if you own that LLC, they still charge a fee. So what were you gonna say?
Philadelphia, it's almost 5%
Of what?
of the fair market value of the property
To transfer it.
transfer. Yeah, 4.2%.
I knew it was high, and that's why I was picking on you because I knew it was high in Pennsylvania.
Philadelphia is stupid high. Philadelphia is even higher than Pennsylvania. Pennsylvania is just 2. The rest of Pennsylvania.
Yeah, this is a little out of my wheelhouse, but I have been told that you can use land trusts as a way to get around the transfer taxes. So again, I'm not a lawyer. I don't pretend to be your lawyer.
Yeah,
Don't
land trusts are super
as a lawyer.
specific though.
Yeah. But I have been told that you can transfer your ownership or you can assign your interest to a land trust, set the land trust up, transfer the property stays in the land trust for like a day and a half, and then it gets put over to the LLC. And then apparently you're able to avoid transfer taxes